In today's episode, I'll talk about three stories. In the first story of the day, I'll talk about how Intel is in trouble and has now become an acquisition target. In the second story of the day, I'll talk about how climate change is becoming an economic threat as time passes by and how it is something central banks cannot really ignore. And in the third story of the day, I'll talk about US tariffs on steel and aluminium and how the ripple effects of it can hit India. Welcome to the Daily Brief Show by Zerodha, where our aim is to cut through the noise and simplify the biggest news and stories in the financial markets in a way that is easy for you to understand, yet one level deeper as compared to your traditional news channels. I'm your host Anurag Bansal, and today is Thursday, the 20th of February. Intel was once synonymous with the global semiconductor industry. It was not just a chip company, it was the chip company. Its dominance felt untouchable almost. Its processors powered most of the world's computers. From its breakthrough x86 architecture to its iconic Intel Inside marketing campaign, this company sat at the heart of global chip making. Most of the world's bleeding edge technology was possible only because of Intel chips. But fast forward to today, that same company has become an acquisition target. Competitors that once quivered before Intel's might are now hoping for its parts. And that is a massive fall from grace for one of the world's most incredible companies. The question is, where did all of it go wrong for Intel? See, Intel's downfall did not really come from a single bad decision. The company made a series of miscalculations and strategic missteps which compounded over time. Intel came from the era of integrated device manufacturing or IDM. It designed chips and then fabricated those chips itself. That means it turned silicon wafers into chips, much like early competitors like IBM or Texas Instruments. From the 1990s onwards though, younger companies began moving to a fabless models where they designed chips and then sent those designs to companies like TSMC and Global Foundries for fabrication. But that, let me tell you, was a bit of a forced decision based on how they could not afford their own fabrication facilities. Intel, meanwhile, on the other hand, prided itself on its ability to do everything in-house. In an era when making chips was relatively simple, this was a huge advantage. But the problem is, it would soon become a very big problem. Meanwhile, in 2007, Apple approached Intel to make chips for its first iPhone. Intel turned it down and they said that it had low profit margins. Now, this was Intel's first great mistake. And because of that decision, Apple decided to license chip designs from the British chip maker ARM, which were then sent to Samsung for production. In a few short years, this turned into an entire industry segment. Very soon, Qualcomm, Apple, and other companies started to build entire businesses around power-efficient processors. Intel, on the other hand, found it increasingly difficult to enter this space in the first place. Most mobile applications, for example, were made on ARM designs and they ran very poorly on Intel chips. The company started to struggle to gain relevance in mobile computing and it exited it altogether in the year 2016. But around the same time, Intel's own chip manufacturing unit, which is the very foundation of its strength, started running into massive problems. See, for years, Intel had set the pace for Moore's law, where they improved the quality of their manufacturing at such a rate that the transistor density in chips doubled every 2 years. But slowly, they started to fall behind on it. When it was time to transition to 10 nanometer chips, things started to go south for Intel. Manufacturing delays, technical roadblocks, and poor execution created room for rivals like AMD to push past Intel. Because after all, unlike Intel, AMD only had to think of chip design and companies like TSMC had to think of how to get the production into place. And this was the era when companies were setting up huge data centers to capture a series of booms from the explosion of the internet to cloud computing as well. And that is where AMD began capturing market share from its rival Intel. See, while Intel struggled with 10 nanometer chips, AMD quickly graduated to 7 nanometers and then even 5 nanometer chips. Its EPYC servers began crushing Intel's equivalents and allowed it to take up a big share of the data center market. And meanwhile, it also began eating into Intel's dominance in PC chips with its Ryzen series. And then came the biggest of all problems, artificial intelligence. See, the explosion of AI after the year 2020 completely reshaped the semiconductor landscape. When it came, it seemed like Intel did not quite grasp the magnitude of what was exactly happening. Intel had built an empire on general-purpose CPUs, but the thing is, AI demanded specialized chips. These were powerful GPUs and AI accelerators. So it was now NVIDIA's turn to shine. See, for a long time, Nvidia was second to Intel and AMD. While these companies were making CPUs, which were the main chips which ran personal computers, Nvidia was playing second with its GPUs that merely made video games run well. But the thing is, these chips had other uses as well. They were really useful in mining cryptocurrency, for instance, and in the crypto boom that began in 2017, they saw steady increase in the demand for its products. And then came AI and changed the game entirely. With its CUDA software ecosystem and AI-focused GPUs, Nvidia became the undisputed leader in AI hardware. Nvidia doubled down and innovated at a crazy rate until it was the undisputed backbone of AI computing. And the rest of the industry has been left playing catch-up, at least for now. Now, Intel obviously tried to respond. It made massive bets on AI hardware and even acquired companies like Habana Labs in order to build AI-focused processors. But these efforts were just too late and they failed to gain significant traction. And because of so much happening over these few years, the semiconductor industry today is very, very different from what it was in Intel's golden era. The thing is, even the biggest players today do not do everything themselves. Both Nvidia and AMD, for example, don't manufacture their own chips and instead they outsource production to TSMC. But on the other hand, Intel actually tried to do everything in-house: design, manufacturing, marketing, and also sales. And that strategy, which was once Intel's strength, actually ended up becoming its biggest liability. In a sense, it was simultaneously competing with two very different industries. These were chip design and fabrication. And each of these have extremely capable and innovative entities right now. Intel simply did not have that flexibility that all of its rivals had. And when Intel realized that it was losing ground, it did try to correct course. Under former CEO Pat Gelsinger, Intel decided not just to make its own chips, but also to manufacture chips for other companies. It effectively tried to transform itself into a foundry like TSMC, where they poured billions into new factories in US and Europe. But timing was again a big problem. While Intel was actually trying to revamp itself, the market was demanding immediate AI breakthroughs. Investors and customers grew very impatient. Gelsinger's vision was very bold, but since Intel was already behind in the race, their execution was extremely slow. And by late 2024, Intel's struggles deepened and the board decided it was time for a leadership change. Gelsinger was pushed out. Intel, by the way, did not just fail in manufacturing, it also struggled with strategic acquisitions. See, over the years, it has made several big-ticket purchases in an attempt to diversify its business. It acquired Altera for $16.7 billion in 2015 in order to gain a foothold in programmable chips. It then bought Mobileye for $15.3 billion in 2017 in order to expand into automotive technology. It even attempted to strengthen its AI play with Habana Labs. But the thing is, none of these bets ever turned into real competitive advantages for them. Nvidia and AMD kept pulling ahead and Intel's acquisitions sort of failed to deliver the impact that they had hoped for. And because of all of this now, Intel has weakened as an entity and therefore they are trying to shed dead weight and they have just laid off over 15,000 employees. In fact, they briefly even stopped offering free tea and coffee to their employees. And therefore, several companies now see an opportunity to acquire pieces of Intel. Broadcom, for example, has offered to acquire Intel's design and marketing segment. Broadcom, for your context, is a powerhouse in semiconductors and networking solutions. They want Intel's intellectual property or IP and branding strength, but they don't seem to have any interest in the capital-intensive chip manufacturing business of Intel. TSMC, on the other hand, which is the world's leading contract chip manufacturer, is eyeing Intel's factories. But the thing is, instead of outright buying them, TSMC is actually considering forming an investor group to take control of Intel's manufacturing operations, which could further solidify its dominance in semiconductor fabrication. Also, Qualcomm, which dominates mobile processors, had back in September 2024 expressed interest in a full acquisition of Intel. Now, if that deal is still on the table and it does happen, it could be one of the biggest semiconductor deals in history. We'd spoken about this on one of our episodes back then, so if you are interested, we'll link it in the description. But the thing is, there is another option for Intel. Apollo Global Management, which is a private equity firm, has proposed investing in Intel for about a 5% stake. If Intel does decide to take this path, it could buy some time to restructure and attempt a comeback rather than be absorbed by its competitors. So then the big question is, what exactly is next for Intel? Does Intel really have the fight left to reinvent itself, or is it simply too late for them? See, the semiconductor industry today is evolving at a breakneck pace, and Intel has repeatedly struggled with their timing. The AI boom, the shift in chip manufacturing, and the rise of fabless giants like Nvidia has reshaped the entire landscape. But also, Intel's legacy is undeniable. Over the years, it has built an extensive portfolio of patents covering almost everything from processor architectures to advanced manufacturing techniques. Its IP or intellectual property remains one of the strongest in the industry, with key innovation in areas like high performance computing and semiconductor fabrication. In addition to that, Intel has also formed strategic partnerships with major tech players like Microsoft, Dell, and Lenovo in order to ensure that its chips power a wide range of their devices. But that said, despite this rich legacy, whether or not Intel really has a future as an independent company really remains very uncertain. Now, let me tell you, this is not really unusual for this industry. In the early 2000s, when Intel and AMD entered the graphics processing space, it seemed like Nvidia would find it very hard to survive. Fast forward to 2008, it seemed like AMD was going bankrupt at that time, and turning fabless was its desperate gambit for survival. Now, both of these companies scripted dramatic turnarounds. The question is, can Intel follow suit, or are we witnessing the death of a massive giant? Either way, this is definitely a development that is worth tracking because the future of one of the most iconic companies in tech hangs in the balance. In the next story of the day, let's talk about something that is becoming more than just an environmental concern. See, central banks around the world lately have started to worry about the economic damage that is caused by climate change. The idea here is fairly simple. When extreme weather hits like floods, hurricanes, or droughts, it does not just affect crops and forests. It can also disrupt factories, destroy infrastructure, and also send prices for food and electricity soaring above. And this in turn pushes central banks to think differently about how they manage inflation, interest rates, and overall financial stability. Now, a new bulletin from the Bank for International Settlements, which is, by the way, often called the central bank of central banks, highlights why these worries are so serious. See, they looked at data from several major economies, especially in the Americas, and found that different types of extreme weather events affect economies in very different ways. Droughts emerged as a particular problem here. When a drought happens, it can hurt economic output for up to 2 years because key industries like agriculture, forestry, and electricity production rely heavily on water. If fields dry up, crops fail. If rivers are low, hydropower plants cannot produce as much electricity. Now, all of these issues affect everything from food prices to the cost of running factory. Now, to see why this matters, you can think about two big events that happened in the year 2024. The first one was floods in Rio Grande do Sul, which affected an area that produces a large share of Brazil's agriculture and has a big manufacturing presence. And in the same year, Hurricane Helene caused severe damage to a major quartz supplier. Now, quartz is a key mineral that is used in semiconductors, so when production was disrupted, it created a ripple effect in global chip manufacturing as well. Now, these kind of surprises show how a disaster in one place can very quickly affect businesses in many other parts of the world. The insurance industry is also facing a lot of trouble as these disasters are becoming more frequent. Insurance premiums can represent anywhere from less than 1% to about 3% of a country's GDP. As extreme weather events happen more often, insurance becomes more expensive and some companies stop offering coverage in high-risk areas altogether. Now, this leaves a gap between what is covered by insurance and the total amount of damage that actually happens in reality. Experts call this the insurance gap, and it has grown to about 60% globally in recent years. And that means a lot of property and businesses end up with no financial protection if a natural disaster strikes. And while data clearly shows more reported natural disasters since the 1980s, we should also be cautious in how we interpret these numbers. See, groups like the United Nations and the World Meteorological Organization have looked at disaster databases such as EMDAT to note a big rise in disasters. But the EMDAT team themselves warn that better reporting and data collection might be part of the reason that these numbers look so high. In the past, many smaller disasters might have never even been recorded, but now with more advanced technology and communication, they are. If we only look at really large events, such as those with more than 1,000 deaths, the trend over time is a little more stable. Now, of course, this doesn't mean climate change is not making natural disasters worse. It just means that we have to be careful about how we read historical records. Estimating the economic cost of climate change is difficult because different models and researchers give us very different answers. Some studies suggest that if the planet warms by 1 degree centigrade more, we might see about a 1% drop in global GDP. Others say that figure could be as high as 25%. And that is a huge range of uncertainty if you think about it. And to make things even more complicated here, there are many ways climate change can affect an economy. Extreme heat, for example, can lower how much work people can do. Storms can smash roads, building, and other assets on the other hand. Agriculture can suffer from droughts, power plants might run into trouble if they depend on water supplies, and all of these impacts can push prices higher, especially for food and energy, which are very important for central banks that keep an eye on inflation. Then there is the question of whether climate change creates one-off hits to the economy or it just leads to a permanent slowdown. If it's just a level effect, it means the economy suffers a serious setback but then returns to its normal growth rate afterwards. But if it's a growth effect, the country's growth rate might really drop for good, making the long-term damage much bigger. Now, this is a very crucial difference because it can mean the gap between a temporary setback and a permanent decline. India's experience offers a real-world example of how exactly this can play out. According to research by the RBI or the Reserve Bank of India, extreme weather linked to climate change is already affecting our food prices. In 2023-2024, a combination of high temperatures and weak monsoon rains led to lower farm output. And when food output goes down, prices generally go up, which is especially hard on people with lower incomes. The RBI's long-term analysis suggests that India's total economic output could be around 9% lower by 2050 than it would have been without climate change. And what's more is that inflation may not only rise but become more unpredictable as time passes by. Even though weaker productivity might reduce the natural rate of interest in the economy, the RBI would still have to keep interest rates high if inflation spikes often. In a speech last year, RBI Deputy Governor Rajeshwar Rao explained that climate risks do not really fit neatly into standard insurance or risk models. When a flood or drought hits, it can devastate entire regions and industries. It is not the kind of risk that can be spread out easily across different groups because everyone in the affected area suffers at the very same time. It can also widen the gap between the rich and the poor since people or businesses with less money find it harder to bounce back. They might not have insurance or savings, and they often work in sectors like farming or construction that suffer the most from extreme weather. And over time, this can lead to what some people call climate poverty traps, where communities or regions fall deeper into poverty after climate shock, making the next one even harder to handle. And because of all of these factors, many central banks are now looking at climate change as a core part of their job. They are finding that climate change could force them to keep interest rates higher to control inflation, even if the overall economy becomes weaker. Now, that combination, which is a weak economy plus rising prices, is sometimes also referred to as stagflation. So the worry is that climate change might force the global economy into a place where high inflation and low growth become more common. It's definitely a complicated situation and many questions do remain. But one thing is certain here. Climate change is not just about saving polar bears or protecting rainforests anymore. It is a direct threat to economic stability, growth, and inflation. Central bankers and policymakers everywhere are now trying to figure out how to deal with it, and the stakes could not be higher because the decisions that they make today could really shape the financial futures for multiple decades to come. On that note, let's move on to the third and the final story of the day. Look, over the last few weeks, we've talked about how America's new tariffs threaten to tear up the delicate balance of foreign trade. Now, in today's story, let's understand how exactly that plays out with one specific tariff. See, Donald Trump has recently announced a fresh set of tariffs on imported steel and aluminium products. The tariff on steel is 25% and the tariff on aluminium is now higher than ever. Many people are worried that these tariffs will shake up trade relations across the world once again, just like it did in 2018. Other countries might respond with their own tariffs and businesses could have to change their supply chains all over again. But to understand what this exactly means for our country, India, we'll have to look at how India deals with steel and aluminium. First, let's talk about steel. See, India is the second largest producer and consumer of steel in the world right after China. Over the last 10 years or so, India has been making more steel each year, but it has also been using even more steel. Big building projects, new roads, and rapid urbanization all mean that we need more steel. In fact, in the past few years, India started importing steel because it was not really producing enough to meet all its needs. This means we now bring in more steel from other countries than we send out to them. When it comes to sending steel to the US though, India is not really a huge player. Only around 4% of India's total steel exports end up in the United States. So at first glance, these new American tariffs may not really seem like a big deal for Indian steelmakers. But we have to remember that steel is a global product. If the US puts tariffs on steel from all over the world, global demand for steel could really drop. Countries that used to sell steel to the United States might look for other buyers, and some of them could turn to India as well. And that means India might see a bigger flood of cheaper steel imports, especially from places like China, which makes half of the world's steel. And even though China's own demand for steel is falling, its factories are still making record amount of steel, which they sell to other countries at low prices. India's building boom is an attractive market, so Indian steel manufacturers could end up facing stiff competition from these cheaper imports. Indian steel companies are already, by the way, feeling the pinch here, and new US tariffs might make the global price situation even harder for them. Then let's look at aluminium. See, India is also the second largest producer of aluminium, although China is way ahead of everyone else. Now, aluminium production in India is very important because we have large reserves of good quality bauxite, which is the raw material needed to make aluminium. And unlike steel, India exports a big chunk of the aluminium that it produces, about 40%. And the United States buys around 6 to 8% of this aluminium export. That number, of course, is not massive, but it is still bigger than the share of India's steel exports going to the US. So if the US makes aluminium imports more expensive through higher tariffs, Indian aluminium exporters will notice the impact more than Indian steel exporters do. But India's low cost of producing aluminium might soften some of the blow. Because our bauxite reserves are abundant and high quality, Indian companies can make aluminium relatively cheaply. This cost advantage should help a little bit if American market becomes harder to sell to. But overall, these tariffs from the US might sound huge if you think about India being the second largest producer of steel and aluminium. But trade rarely follows simple patterns. Steel and aluminium both are bulky and heavy, so moving them across oceans and continents is very expensive. The US tends to buy most of its steel and aluminium from nearby countries like Canada, Mexico, or Brazil. India does ship some steel and aluminium there, but not nearly as much as these close neighbors. And that means the direct impact might be smaller than what most people fear at first. But still, that said, India cannot really breathe a sigh of relief and ignore it. Global trade is connected in very complicated ways. When the US shuts its doors to some suppliers, those suppliers start to look elsewhere. If more cheap steel arrives in India from around the world, Indian steelmakers will feel more pressure on their profits. The aluminium industry is also tied in with global demand. It is not just about what India sells to America, it is also about how the rest of the world reacts. So yes, the direct hit to Indian steel and aluminium exports may be limited, but these are second-order effects that can spread far and wide. India's steel sector is already facing tough competition from foreign producers, especially China, and these new American tariffs could really push more steel into India's market. Meanwhile, Indian aluminium makers that sell directly to the US could see higher costs and maybe lower sales. And all of this could have a chain reaction on production, prices, and even employment in these industries. So in short, tariffs may look simple on the surface, which is one country taxing another's goods. But in reality, when something like this actually happens, there is always a web of direct and indirect changes that spread across the globe. With that, let's move on to the final section of the day and talk about the quick news headlines. First, despite the RBI's 25 basis points repo rate cut, corporate bond yields continue to rise due to a 1.8 lakh crore liquidity deficit in the banking system. In February, the yield spread between corporate and government bonds widened by 25 basis points, driven by a surge in corporate debt issuance. The 5-year AAA rated corporate bond yield stands at 7.46%, while the 10-year yield is at 7.3%, leading to an inverted yield curve. Second, India's oil imports from the US jumped to 218,400 BPD in January from 70,600 BPD in December, making the US its fifth largest supplier. Meanwhile, Russian imports rose 4.3% to 1.58 million BPD, but future purchases could decline due to sanctions. Middle Eastern crude surged 6.5% to 2.7 million BPD, pushing its share in India's oil imports to a 27-month high of 53%. Third and the final one for the day, India's urban unemployment rate declined to 6.4% in Q3 of FY 2025, down from 6.5% in Q3 of FY 2024 as per NSSO survey. The joblessness rate for women improved to 8.1% from 8.6%, while for men it remained at 5.8%. The survey covered 45,074 households and 1,70,487 individuals under a rotational panel method. That's all the news and stories I have for you today. I hope you enjoyed this episode and maybe learned something new from it today. This is your host Anurag Bansal signing off. I'll see you in the next episode. Take care and goodbye. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.